All right. Dealing specifically more with alimony and child support. So if you have a divorce, you may be paying alimony, which again is just kind of just payments to the ex-spouse, and child support, you're paying to help support the child. Alimony is a legally required payment made by one spouse to the other for their financial support after divorce or separation, for agreements executed on or before 12/31/2018. And this is one of those instances in which the exam will give you real dates. So just as a good general rule, if you see real dates such as 2016, 2017, 18, 2023, anything like that, it is likely referring to a real rule. If you see year 1, year 2, then there's likely no difference. There's nothing to read into there. So you will see questions talking about divorces from before, because guess what? There are still people that have divorces that were finalized before that date, and you will see questions about after that date. So just keep that in mind. Be ready for all of it. So before that, alimony would be deductible for the paying spouse, which is the payer, and considered taxable income for the receiving spouse, which is the payee. This means the payer can reduce their AGI by the amount of the alimony paid, while the payee must include it in their taxable income. Child support is a payment made by one parent to the other to help cover the costs of raising their child after a divorce or separation. These payments are neither tax deductible for the payor nor taxable for the payee. This means that the payer cannot reduce their AGI by the amount of child support paid, and the payee does not need to include it in their taxable income. As I like to say, think of the children, right? Just don't tax that amount. Let that all go to the children. Now, one type of question you will see this context where, oh, the overall payment after the divorce is $1,000 per month. And then once the child turns 18, the payments go down to $600. But what does that mean? What can you infer from that? If the payments go down to $600, that means once the child turns 18, they're not getting child support anymore. That $600 is the alimony. That means that $400 was child support. Because again, once a child turns 18, there's no more child support legally required. And as such, that is going to be a distinguishing factor. One thing we will see also in those types of questions is that, let's say the payor, right, the person paying the alimony and the child support, doesn't have enough money, doesn't pay the full annual amount. The money goes to the child support before it goes to alimony. So that does have tax implications as well, especially more so if we have a divorce agreement before that 2018. And then property settlements. These are non-taxable / non-deductible. Property settlements refer to the division of assets between spouses during a divorce or separation. She gets the car, he gets the house, back and forth, yada, yada. These may include real estate investments or other valuable assets. When assets are transferred as a part of a property settlement, the transfer is neither tax deductible for the payer nor taxable for the payee. This means the payer cannot reduce their AGI by the value of the transferred assets, and the payee does not need to include the value of the assets in their taxable income. However, the payee may still have tax responsibilities associated with the assets, such as taxes on rental income or capital gains if they go on to sell those assets in the future. Gotta love it. All of these just super bright, cheery topics throughout reg, dealing with divorce, dealing with all of these things. It's a time, isn't it? Well, we'll get through it together. We'll keep it peaches and roses and happy, upbeat. All right, here are some more points about alimony and child support. Now, this is presumably for before 2018, because it says for alimony payments to be deductible by the payor, they must meet certain conditions as specified by our wonderful IRS. These conditions apply only to divorce or separation agreements before 2018. For agreements executed after that date, none of this is relevant. So just keep that in mind as you see questions. First off, in order for alimony to be deductible or for it to be considered legal alimony and to follow the rules from before 2018, payments must be legally required under a written divorce or separation decree or agreement. So the alimony payments should be mandated by a court order or a written agreement. You can't just say, oh yeah, just nothing was agreed upon, I just give them $600 a month. Nope, it's actually got to follow this rule here. Voluntary payments or payments not specified in the legal documentation do not qualify for the deduction. Payments must be in cash or its equivalent, such as check, something like that. Alimony payments should be made in cash, check, or money order. Payments in the form of property, services, or any non-cash equivalents do not qualify as deductible alimony. And again, why is that important? Well, because if it is a divorce from before 2018, you want to be able to deduct this for sure. Payments cannot extend beyond the death of the payee spouse. The alimony obligation must terminate upon the death of the receiving spouse. If the payments continue after the payee's death, they do not qualify as deductible alimony. So let's say we have an agreement and I am paying, but that money goes to a trust, and once this person dies, the payments continue. As such, that's not considered alimony. That's considered just payments to a trust. So that's just another criteria as well that we will see. Payments cannot be made to members of the same household. Oh, that's also if you're actually divorced, if you're separated, you cannot be living together. So that's another criteria. Payments must not be designated as anything other than alimony. A nice catch-all there. The divorce or separation agreement must explicitly state that the payments are intended as alimony or spousal support. If the payments are characterized as child support, property settlements, or any other form of payment, they are not going to qualify as deductible alimony. Classification is the name of the game there. Now, if all of these conditions are met, the alimony payments can be deducted by the paying spouse to arrive at their AGI. Conversely, the receiving spouse must include these payments as taxable income on their tax return. And it's really not too tricky. This applies if it's before that 2018 date. If it's after, we just don't think about it. We don't worry about it. All right, let's see an example here. We've got our John and Jane's divorce on December 1, 2018, with their separation agreement requiring John to make monthly alimony payments of $2,000. As their agreement was executed before December 31st, 2018, these payments qualify as deductible. It also says requiring John to make the payments, and this will also be taxable income for Jane. So John's annual alimony payment is $2,000 times 12, $24,000 a year. Jane's annual taxable amount is the $24,000. So John's AGI will decrease by 24, whereas Jane's AGI will go up by 24. Talking about child support, let's say that John and Jane have 2 children, and John's required to pay $1,000 per month for child support. John's annual child support payment is going to be $12,000. Now, in this case, John cannot deduct the child support payments from his AGI, and Jane does not need to include them in her taxable income. The IRS, before the changes and after the changes, nothing changed there, saying, think of the children, just let's not tax that money, have it go right to the children, benefit them. And then property settlements. As a part of their divorce agreement, John agrees to transfer a rental property worth $200,000 to Jane. In this case, John cannot deduct the value of the property from his AGI, and Jane does not need to include the value of the property in her taxable income. However, Jane will be responsible for anything else. It's her asset now, so any sale of the asset, any transfer of the asset, taxes, anything like that, will be Jane's responsibility. All right, student loan interest. Let's run through it here. Let's assume the following scenario for an individual taking a deduction for student loan interest expense. The individual has a modified adjusted gross income of $70,000. The student loan interest deduction threshold for the year is $2,500, and the individual paid $3,000 in student loan interest during the tax year. Let's calculate the deduction. Well, the maximum is $2,500, and the actual paid was $3,000, so we can only claim up to the $25,000. A little bit of a distractor there. Now, in this example, the individual can deduct up to $2,500 for the student loan interest from their taxable income. This would reduce their taxable income from $70,000 to $67,500. Not too crazy of an example, just showing you how it works. It's a lot better when you see an example. You're like, oh, that's real now. It's not just words on a page. So I guess this still is words on a page, but it is demonstrating how this actually works.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.